Hello everyone, and welcome back to Dr. Tao's Quant Lab. Over the last few lectures, we have talked extensively about the S&P 500, the Magnificent Nine, and the various macroeconomic sectors. But here is the practical reality. An index is just a mathematical concept. It is a number on the screen. You cannot directly buy the S&P 500. To actually put capital into the market and trade these macro concepts, you need a physical vehicle. Today, we are going to introduce the most important vehicle in modern finance, the Exchange Traded Fund, or ETF. An ETF is a put investment security that holds a basket of underlying assets. But unlike a traditional mutual fund, which only prices once a day at the market close, an ETF trades on an exchange exactly like a single stock. Its price fluctuates second by second. You can buy it at 10 a.m., sell it at 10:05 a.m., short sell it, and trade options on it. Because of this intraday liquidity and structural flexibility, quantitative traders almost exclusively use ETFs to execute their algorithmic strategies. Beginners often make the mistake of assuming ETFs only hold stocks, but the ETF structure is just a wrapper. It can be built around almost any financial instrument. There are five major asset classes of ETFs: equities, tracking broad stock markets like SPY for the S&P 500. Currencies, tracking foreign exchange rates like UUP for the US dollar. Commodities, tracking physical resources like a GLD for gold and SLV for silver. Fixed income, tracking the bond market like AGG. And the fifth, alternatives, tracking complex derivatives like UVXY to trade market volatility. When you look at an equity ETF, you must immediately determine if it is passively or actively managed. A passive ETF is a bland algorithmic index fund. It doesn't pay human analysts to pick stocks, so its fees are virtually zero. An active ETF, however, is run by highly paid managers trying to beat the market, and they charge a premium for it. So, the quantitative question is the active manager worth the higher fee? Let's look at the Morningstar active versus passive barometer table in your textbook. The data is devastating over a 20-year horizon. What percentage of active US large cap growth managers actually beat their passive benchmark? Just 1.5%. And now you can notice some green on that chart. Active managers can sometimes win in the short term in fixed income because the bond market and others is structurally less inefficient, allowing them to systematically take on extra credit risk or trade new issuances. But look at the 20-year column. Even the active bond managers eventually lose to the math. The primary culprit is free drag. Because active managers charge higher fees, They start every year mathematically behind the index. Therefore, our quantitative rule for thumb is this. For long-term wealth compounding, always the passive index funds from giants like Vanguard or State Street. Save the active funds like ARK Invest or leverage the ETFs from ProShares strictly for short-term tactical trading. Okay, so the names are right here. Now, how do institutions use these passive ETFs? For decades, the gold standard of wealth management has been the 60-40 portfolio. You put 60% of your capital into an equity ETF, like as an SPY, and act as your growth engine. You put the remaining 40% into a treasury bond ETF, like TLT, to act as your defensive anchor. This split is mathematically derived from modern portfolio theory. Historically, when the stock market crashes, the Federal Reserve cuts interest rates. When rates drop, bond prices rise. Therefore, during a panic, your 30% bond allocation goes up, mathematically offsetting the heavy losses in your stock portfolio. It is the ultimate free lunch of diversification. We just stated that the 60-40 split optimizes return for the given unit of risk. But how do we mathematically prove that? In our next lecture, we will introduce the ultimate quantitative tool for evaluating risk and return, the Sharpe ratio. See you in the quant lab.